Welcome back to the deep dive. Today, we are diving into a pile of really granular research on a name that operates deep within the U.S. defense ecosystem,
Right.
but it remains largely undiscovered by the mainstream market. The company is Castellum Inc., ticker CTM.
And this is a fascinating one. It's a microcap defense contractor.
Mm.
And it's been through a really profound and, let's be honest, a pretty messy internal restructuring.
Messy is a good word for it. They've shifted from this, aggressive acquisition spree
hmm
to a model focused on just ruthless operational discipline.
And this isn't just another small cap story. The financial shift here is so dramatic that it's created a genuine investment anomaly.
An anomaly. Yeah.
We are looking at a company that is showing all the hallmarks of a rare, deep value play, but specifically in the defense space.
Yeah.
And you can only see it if you look past the legacy balance sheet issues.
Okay, so when you say anomaly, what's the core thesis? What's the one thing that makes this company stand out right now?
The core insight, and really the thing you need to remember from this deep dive, is the powerful margin of safety that has just suddenly appeared on the balance sheet.
Margin of safety.
Exactly. As of today, Castellum holds nearly 18% of its entire market capitalization in net cash.
18%.
That is liquid funds remaining after you subtract all the debt. And this is happening even while some analysts are projecting north of 200% upside potential if management simply executes its current growth plan.
So the market is just stuck.
Completely paralyzed.
Yeah.
It's trying to figure out if this is a highly disciplined, re-rated operator that's ready for explosive growth, or if it's just another risky, illiquid microcap turnaround story that's destined to fizzle.
And we think the evidence points which way?
We believe the evidence strongly favors the former.
Okay, so that is the mission for this deep dive. We've based this analysis on an exhaustive, granular research report grounded in classic value investing principles. Our goal is to give you, the listener, the learner, all the critical, synthesized data points you need to fully grasp the Castellum investment thesis as of November 2025.
And we absolutely have to set the stage here. CTM doesn't operate in a vacuum.
Not at all.
The macro environment of 2025 is defined by several factors. You've got high interest rates, which makes debt really expensive.
Yeah.
You have significant geopolitical instability, which is driving sustained defense spending. And then you have the specific dynamics of microcap valuation, where institutional ownership is low and volatility is, well, it's very high.
And the speed of their turnaround is the key.
That's it. The speed at which they executed this transition from massive debt and losses to now profitability and a net cash position.
Yeah.
That's what makes this story so compelling. It demonstrates a rare commitment to maturity.
Okay, let's unpack this, starting with the structure. We are tackling this in two parts. Part 1, chapters 1 to 3, business, management, and financials. Chapter 1, business understanding.
All right. To truly appreciate the CTM of today, you have to acknowledge the CTM of yesterday. The entire corporate evolution is defined by this necessary and sometimes painful pivot between what we're calling phase 1 and phase 2.
Let's define phase 1 clearly because that's what created the initial financial mess. What exactly was that aggressive roll-up strategy and why did it fail to create immediate value?
Phase 1 was all about aggressive revenue aggregation. The strategy was to rapidly consolidate the highly fragmented lower middle market of defense contracting,
Okay.
specifically targeting these high-demand areas, like cybersecurity, electronic warfare, or EW and information operations, IO.
It sounds like a classic private equity model.
It is. Buy revenue quickly, try to achieve critical mass, and then you just hope that the eventual synergistic value, things like reduced back-office costs and cross-selling. You hope it materializes fast enough to offset the massive debt you just took on.
But the reality of roll-ups is often far messier than the boardroom presentation, isn't it?
Oh, always. They struggled. They struggled under the weight of disparate corporate cultures, high overhead costs, and a highly leveraged, very messy balance sheet.
So what was the turning point?
The pivotal moment came mid-2024 with the shift to phase 2, and this was under the new CEO, Glen Ives. This pivot was a commitment to, for lack of a better word, adulting.
Right.
It was defined not by acquisition, but by operational integration, cost discipline, radical debt reduction, and a laser focus on achieving and sustaining GAAP profitability.
So they stopped being just a collection of assets.
And started functioning as a unified operator.
I know.
Exactly.
Let's get granular on the subsidiaries then. The specific operational engines that generate this stable defense revenue. The report outlines 3 core units, starting with SSI, Specialty Systems, Inc.
SSI is the absolute bedrock of the company. They provide the reliable, sticky revenue that investors, that they crave.
City revenue.
They specialize in critical engineering and logistics services and are deeply, deeply embedded at the Naval Air Warfare Center Aircraft Division, NACA at Lakehurst.
And that's not just any military base.
Not at all. Lakehurst is responsible for supporting the Navy's Aircraft Launch and Recovery Equipment, or ALRE.
ALRE?
These are the specialized mission-critical systems that ensure planes can land and take off safely from aircraft carriers. I mean, if SSI stops working, the carriers stop working. It's that simple.
And that incumbency, that deep-rooted presence, it translates into massive contract wins.
It has to.
Which is vital for long-term revenue visibility. We saw proof of that just last month in October 2025.
That's right. The $66.2 million full and open contract win in October 2025 was crucial validation for this whole Phase 2 strategy.
Put that number in context for us.
Well, to put $66 million in context against a company with less than $60 million in annual revenue, it's huge.
Yeah.
Furthermore, a full and open contract means they beat out not just other small businesses, but the larger primes too. So this win doesn't just provide revenue visibility for the next 5 years.
Right.
It demonstrates their indispensable technical expertise and allows them to significantly improve employee recruitment and retention. Top talent is drawn to these long-term funded programs.
Okay, so that's the stable base. Moving to the intellectual capital side, we have Corvus Consulting.
Corvus focuses on the higher margin intellectual layer. So information warfare, IW, and electronic warfare, EW.
Okay.
They employ highly specialized staff. Often, these are former military intelligence and operational officers who provide strategic doctrine, training, simulation support.
So they're not just providing bodies.
No, they are selling high-value expertise in strategic thinking, and that fundamentally separates CTM from, basic IT staffing providers.
And finally, GTMR, the engineering and testing unit. This is the one that holds the critical security advantage, right?
This is GTMR's crucial competitive differentiator. It is a massive barrier to entry. They were selected as a vendor for a substantial $249 million shared ceiling IDIQ contract.
Which is a major validation.
A huge validation. But the real moat is their ability to handle special compartmented information, or SCI.
SCI.
Working with SCI requires physical and procedural infrastructure. You need SCIFs, specialized personnel training, a whole security clearance apparatus that takes years and millions of dollars to build and maintain. If you don't have that, you simply cannot compete for the highest value, most sensitive government work. Period.
So we have stability from SSI, high-value consulting from Corvus, and that secure clearance infrastructure through GTMR.
Correct.
But the traditional services model, it provides stability, but it kind of locks CTM into linear growth. To unlock that non-linear scaling that value investors dream about, they had to fundamentally change how they sell.
That's exactly right.
So let's talk about CATP and Guard Tower AI.
Precisely. This product-service hybrid strategy, operating through their subsidiary CATP, which stands for Castellum Advanced Technology Products, this is the company's growth optionality. The traditional time and material service model is safe, but your margins are capped, maybe 5 to 10% net. And your growth requires constantly hiring new, cleared staff. It's linear.
So the path to better margins is through products.
It's product reselling.
Yeah.
That's the path to nonlinear scaling.
Let's deep dive into the Tradewinds Networks and Guard Tower AI partnership. This seems to be where the trust factor really comes into play.
It is. The Pentagon is currently undergoing a massive initiative to rapidly adopt what they call COA test technologies commercial off the shelf.
So private sector tech.
Everything from advanced data analytics software to edge AI infrastructure and high-end cybersecurity appliances. The goal is speed and agility.
But you can't just plug a commercial product into a classified network.
It's incredibly difficult. Selling a CIA test product directly into a classified government network, one governed by those SCI protocols we mentioned, is almost impossible due to security verification.
And that's the niche CTM carves out. They become the trusted agent.
That's exactly right. Castellum uses its existing, validated, top-secret facility security clearance, their FCL, and its deep, long-standing customer relationships to act as the intermediary.
So they vet the tech.
They take the Guard Tower AI platform, which is an advanced, cutting-edge solution for data processing at the network edge, and they integrate it, they verify it, and then they resell the software licenses and the necessary hardware into those secure environments.
And that gives them nonlinear growth.
because software license margins are dramatically superior to labor margins. This shift, if it's successful, it fundamentally transforms the entire investment proposition.
And the timing for this strategy couldn't be better given the tectonic plates shifting in defense procurement.
Right.
Take the Department of Defense's move toward JADC2.
JADC2, Joint All-Domain Command and Control. It's the military's concept for connecting every sensor, every shooter, every decision maker into a single, massive, integrated network.
So it's a move away from hardware.
It requires moving away from heavy physical infrastructure, what we call the metal, to flexible, agile software and data, the code.
And that favors smaller companies.
This strategic pivot favors contractors like CTM, who specialize in systems integration, cybersecurity, software engineering. They're more agile than the traditional heavy systems integrators. They can operate at the speed the DoD needs right now.
We also have the specific geopolitical pressures of 2025, the supply chain balkanization, and this new tariff environment.
This protectionist wave, with tariffs ranging from 10% up to over 60% on certain imported components, it puts immense pressure on the defense supply chain to be verifiable and domestically secure.
Which for CTM is an opportunity.
For CTM, a U.S. domiciled cleared contractor, this is a massive tailwind for their specialized cyber supply chain risk management services, or CSCRM.
Can you elaborate on that CSCRM service? I mean, what risk are they mitigating that the government is willing to pay over $3 million for?
So defense contractors, they rely on thousands of components sourced globally. If one semiconductor or one circuit board comes from a potentially hostile nation, it introduces massive security vulnerabilities.
Like backdoors.
Backdoors, potential espionage, or simply hardware failure at a critical moment. CTM's CSCRM service is about auditing, verifying, and securing that entire supply chain.
And that $3.2 million contract they won?
The $3.2 million CSCRM contract awarded to SSI is a clear signal that in the 2025 environment, the government views supply chain integrity as a high-priority, high-value problem that has to be solved, regardless of the cost.
You also mentioned the Valley of Death, which is a structural challenge facing companies this size. What is that?
The Valley of Death is this danger zone where a successful small business one that benefited from government set-aside contracts grows too large to qualify for those small business advantages.
But they're still too small to compete with the big guys.
Exactly. They're too small to compete directly with giants like Northrop Grumman for the mega programs.
So what's CTM's strategy to cross that valley?
Their calculated strategy is key. They have to gain access to unrestricted, massive, government-wide IDIQ contracts like OASIS plus SPOT.
And IDIQ being?
Indefinite delivery, indefinite quantity. It's like a pre-approved hunting license. And by teaming with partners, they can effectively simulate the scale of a larger prime, giving them a seat at the table for billions of dollars in task orders they otherwise couldn't bid on. It's a pragmatic, necessary strategy for continued growth.
So if we look at this through the lens of assessing their competitive advantage, their moat, what are the durable pillars here?
I'd say there are three pillars that really lock out casual competitors. First is the regulatory incumbency. Their top-secret facility security clearance, their FCL, coupled with their specific SCI infrastructure. It's a monumental barrier to entry.
It's not something you can just go out and buy.
No, it's a multi-year, complex, bureaucratic, and infrastructure hurdle. And critically, their deep incumbency at places like NOCAD Lakehurst means switching costs for the Navy are astronomical.
Okay, that's one. Second is that contract access.
Yes. The prime spot on the OASIS plus unrestricted contract vehicle is a major advantage. It means the government has already vetted them, which drastically reduces the procurement friction for future task orders across dozens of agencies.
A licensed hunt.
That's a great way to put it. It's a license that only highly qualified firms receive.
And finally, the intangible asset that's so difficult to quantify on a balance sheet, the personnel networks.
In the defense and government services world, relationships are king. CEO Glen Ives' extensive background as a naval aviator and his deep connections within key Navy and Army commands. Those are priceless.
Right.
Contract officers and program managers trust him and his team. This intangible network often translates directly into opportunities and provides a significant competitive edge that a competitor just cannot replicate through an acquisition.
Chapter 2, Management Evaluation.
Moving from the technical moats to the leadership. Management evaluation is absolutely critical in microcaps, where execution risk can just sink a whole thesis.
And Glen Ives, the CEO, he seems to be the key figure here.
He is the reason Phase 2 happened. His background is a former naval aviator and an experienced operator in other defense contractors, like Sabre Systems. It dictated this cultural shift. Since taking over in mid-2024, his focus has been almost entirely on operational streamlining and, crucially, the cleanup of that toxic balance sheet.
And he actually delivered on that.
The fact that he successfully raised capital and executed a plan to retire the bulk of the expensive debt, reducing it from over $12 million to just $2.4 million, it confirms his focus and his competency.
What's fascinating is what the report calls the anti-promoter CEO approach.
It's almost boring, isn't it? Which is a good thing.
Right. In the microcap space, you expect hype, you expect buzzwords, promises of disrupting the market.
In Ives, he uses his public appearances to discuss things like funded backlog, debt reduction, and operational discipline.
Not exactly exciting stuff.
And that lack of typical small cap hype is probably the most bullish, confidence-inspiring signal of all. He's positioning CTM not as a speculative venture, but as a mature, disciplined operator focused on reliable government revenue.
We do have to address the founder, Mark Fuller. He was the architect of Phase 1, and he's still a major shareholder. Investors often overreact to insider sales, and he had a notable one recently.
He did. But Fuller remains highly aligned. He still holds about 6.1 million shares.
Okay.
His September 2025 sale of 500,000 shares, which generated about $560,000. It has to be seen in context.
So it's not a red flag.
No. When a founder transitions from the CEO role to a director, it's often a standard, healthy diversification event. This is not abandonment. It is the natural financial evolution of a founder decoupling some of their personal wealth from the company after successfully setting the stage for the next phase.
And the incentives for the new team are aligned.
Crucially, yes. The incentives for the new regime, Ives, and the CFO, David T. Bell, are explicitly tied to long-term performance via vested stock options that were granted in November 2025. This ensures their focus remains on equity appreciation.
Speaking of CFO David T. Bell, his role in the financial stabilization seems absolutely central.
It is entirely central.
Yeah.
Achieving the company's first-ever GAAP net income in Q3 2025 is a direct reflection of the rigorous cost control he implemented.
Right.
And the debt restructuring, that single most important financial decision, that required sophisticated planning and execution. The board's grant of 225,000 stock options validates his success, and it incentivizes him to manage the transition to sustain profitability.
So let's assess their capital allocation strategy as a whole. The entire focus shifted from M&A to stability and organic reinvestment.
And that decision to deleverage was the strategic masterstroke of the entire turnaround. In an environment where the 10-year Treasury is sitting around 4%, carrying $12 million in high-interest debt was just an anchor.
Right.
By reducing it to $2.4 million, they de-risked the equity overnight, removed the threat of crippling interest payments, and liberated significant operating cash flow.
So the capital is no longer being spent on expensive acquisitions.
Correct. Phase 1 was about buying growth. Phase 2 was about earning it through superior execution. Management is now directing capital toward organic business development.
Like what?
Bidding on major recompetes and strategic IDIQ vehicles like Oasis plus Caddy. This inherently provides a much higher long-term return on invested capital ROIC than paying high premiums for often unintegrated acquisitions.
And the large cash pile, $17.8 million. Is that really necessary for a services firm?
It serves two essential reinforcing functions. First, it creates a fortress balance sheet. In defense contracting, financial stability is a non-negotiable requirement for government customers.
So the government wants to see that cash.
Having that much cash reassures the contracting officers that CTM is not going to fail mid-contract. Second, it provides optionality.
For what? Buybacks.
While they wisely prioritize cash over dividends right now, that money provides the resource base for future internal expansion or strategic, opportunistic share buybacks if the market severely undervalues the equity.
Okay, now let's get into the calculation that really defines efficiency. The ROIC analysis, this figure is, it's wildly distorted, but it tells a powerful story.
This is the nuance we need to slow down and analyze critically. We calculate ROIC to understand how efficiently a company uses its invested capital to generate profits.
Right.
We start by estimating the annualized net operating profit after tax, or NOPAT. Based on the Q3 2025 operating income of $450,000, that annualizes to approximately $1.8 million in NOPAT.
And the denominator, the invested capital, this is where the balance sheet cleanup truly warps the math.
It does. Invested capital is defined as total equity plus total debt, minus the cash they hold. So using the Q3 figures, 20.2 million in equity plus 2.4 million in debt, minus that massive $17.8 million cash pile.
Which leaves very little actual capital invested.
This subtraction leaves the tangible invested capital required to run the business at a remarkably low figure of only $4.8 million.
Wait, 37.5% is an absurd number for this sector. We need to be critical here. How much of that is genuine operational efficiency, and how much is just a mathematical distortion created by subtracting that huge cash pile from the denominator?
You are absolutely right to question the magnitude. The 37.5% ROIC, that's the 1.8 million in no-pat, divided by the 4.8 million in invested capital, it is mathematically inflated by the distortion of that cash hoard.
So what's the real takeaway?
The insight is genuine. It confirms that the underlying service business is inherently capital light. Now that the debt load has been paid off, the remaining core operation requires very little tangible capital to generate significant earnings.
So it's a high-quality business model.
A high, even if distorted, ROIC confirms that this is fundamentally a high-quality service business, and that's a characteristic often found in superior long-term compounders.
Chapter 3, Financial Health.
Now we move to the hard data. The numbers that prove the turnaround is real. The financial health of CTM, especially those Q3 2025 breakthrough results.
And Q3 really was the turning point.
Q3 2025 was the moment of fundamental validation for the entire Phase 2 strategy. They reported record quarterly revenue of $14.62 million.
Which is up how much?
A 26% year-over-year increase. But the landmark event, the thing that opens the door to institutional investment, was achieving the first ever GAAP net income, $390,000. This milestone is non-negotiable for many funds.
Okay, but there's a complexity in the margin data that could confuse some people. Gross margin actually fell from 42.7% to 37.6%.
Right.
If revenue is growing and profit is up, why is the gross margin falling? That sounds completely counterintuitive.
This is a critical nuance in government services. The drop of 510 basis points is primarily a function of a successful shift in their contract mix.
A shift to what?
When CTM won that massive $66.2 million NACAD logistics contract, that type of high-volume, cost-plus-based work often carries a lower percentage gross margin than, say, high-end consulting work.
So they're trading margin percentage for sheer volume and stability.
Exactly. And crucially, the total gross profit dollars still increased. It went from 4.96 million to 5.49 million.
So the gross margin percentage decrease is actually a positive sign because it signals they're winning larger, stickier contracts. And the true measure of success is found further down the income statement.
That's it. The key measure is operating leverage. Costs like selling, general, and administrative expenses, SG&A, were held in check. They showed extreme cost discipline. Those costs did not scale linearly with a 26% revenue growth.
And because they contained overhead.
The operating income, or EBIT, it swung massively from a $1.38 million loss in the prior year to a $450,000 profit this year. That swing proves they can successfully scale their current operational base without adding proportional overhead.
Let's pivot back to the balance sheet. This is really the cornerstone of the deep value thesis, what you called the fortress narrative.
The balance sheet improvement in 2025 is nothing short of breathtaking. Cash and equivalents surged to $17.8 million, driven by operational cash flow and prudent capital management. Meanwhile, total debt plummeted to a negligible $2.4 million.
It's a deliberate strategy.
Completely deliberate.
Yeah.
It's designed to build confidence with both the market and, more importantly, with the government customer.
So let's quantify that turnaround using the net cash calculation.
It's the shift from danger to safety. At the end of 2023, the company was heavily burdened with a net debt position of negative $10.6 million.
Right.
By September 2025, they had executed the debt restructuring to the point where they are now in a commanding net cash position of $15.4 million.
And connecting that $15.4 million in net cash to the current market cap, which is sitting around $98.9 million, that gives us the hard floor, the safety ratio.
Correct. That cash position represents nearly 18% of the company's current market value. For listeners unfamiliar with the concept, this is the net, or the liquidation floor that classic value investors talk about.
So what does that mean in simple terms?
It means that even if you assign zero value to the operating business, The equity is still backed by a floor of liquid assets worth roughly 85 cents per share. This cash provides the core margin of safety. It significantly limits the downside risk.
Okay, beyond net income, we need to focus on free cash flow dynamics because this is what determines intrinsic value.
The outlook for free cash flow, or FCF, is strong. FCS starts with net income, but we have to add back non-cash expenses, which are significant for CTM.
Like what?
Things like roughly $370,000 in depreciation and amortization and $280,000 in stock-based comp. These add-backs mean the underlying operating cash flow is very robust.
And as a capital-light services firm, their CapEx should be minimal.
That's right. We estimate annualized operating cash flow somewhere between $4 and $5 million. And after just nominal capital expenditures, mostly for IT and facility upgrades, that results in an annual free cash flow generation of approximately $3.5 to $4.5 million.
And if we look at that FCF relative to the size of the operating business, what does the cash yield tell us?
So we use the enterprise value, or EV here, which strips out the cash. That's the $98.9 million market cap minus the $15.4 million in net cash, leaving an EV of $83.5 million.
Okay.
Based on that EV, the FCF generation gives us an FCF yield of approximately 4.2 to 5.4%.
Which is pretty healthy.
That is a very healthy yield for a company in a turnaround phase that is simultaneously growing its top line by 26%. It means CTM is proving it can earn money using very little capital, and it's generating cash flow at a rate that is inexpensive compared to its operating size.
Okay, let's ground all this in quantitative reality using the discounted cash flow or DCF model. What's the base case look like?
We start with a conservative base case. We assume Phase 2 execution continues, with revenue growth tapering from 20% down to a 5% terminal rate.
Okay.
And we assume a conservative steady-state EBIT margin of 5%. So we're factoring in some initial success with the product expansion. We use the 10% weighted average cost of capital, or WACC, which is a pretty standard hurdle rate for a company with this risk profile.
And that model suggests the market is currently behaving rationally. It's pricing in the basic execution risk.
It does. Our DCF base case comes out to an implied share price of $1.07.
Right around where it's trading.
Exactly. Given the current market price of $1.05, the market has priced in operational stability and moderate success. You are paying fair value for the stable services business, plus you get the downside protection of the cash.
But the excitement, the asymmetric return that comes from the bull case, this is the free optionality we keep talking about.
This is the scenario where the GuardTower AI product scales successfully and transforms the margin profile. If those high-margin license revenues push the sustainable EBIT margins up to 8%.
Which is achievable.
It's a level achieved by tech-enabled peers in the defense space. If they do that, the implied share price jumps dramatically to between $2.45 and $3.
Wow.
This upside scenario offers 150 to 200% returns. Essentially, you buy the stability and the cash floor at the current price, and you get the possibility of that massive product-driven growth for free.
That brings us to our mid-show action. If this level of granular analysis is helping you gain knowledge quickly and thoroughly, please take a moment right now, like and subscribe to Stock Analytics AI.
And for €4.99 a month, you can gain immediate access to our library of 500-plus deep dive videos on all S&P 500 stocks, with the NASDAQ 100 coming next, plus members-only requested deep dives like this one, based on exhaustive, granular research. Okay, let's keep moving into the mechanics of the market, Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
Market sentiment is crucial for a microcap attempting a turnaround. So how are the professional analysts viewing CTM, and how is the stock trading technically?
Right. What's the Wall Street view?
The analyst coverage is thin, which is pretty typical for a company of this size, but it is unequivocally bullish. The consensus 12-month price target is a striking $3.57.
Wow, that implies an upside of over 200% from today's price. The consensus rating is strong buy.
It is.
That seems wildly optimistic compared to our $1.07 base case.
I mean, given the illiquidity and the execution risk, shouldn't we view that 357 target as pure fantasy, reserved only for a flawless execution scenario? That's a very fair assessment. It's highly probable that this high target is derived using sales multiples. They're projecting future revenue growth, assuming the GuardTower AI product is wildly successful and they win every contract in sight.
So they're pricing in the full bull case.
They're pricing in the full bull case outcome we discussed earlier, likely using 1.5 to 2 times projected 2027 sales. It's important for value investors to recognize that 357 is the ceiling of optimism, not the likely outcome.
What's fueling the current momentum, then, is that textbook sequence of positive news flow we saw in late 2025.
It was a perfect strategic rollout. It validated the turnaround sequentially. On October 31st, the $66.2 million NACAD contract was announced. That provided the long-term revenue visibility.
Right.
1 week later, November 7th, brought the Q3 earnings, which was the profit validation milestone. Then on November 13th, the successful retirement of a key note payable cleaned up the balance sheet.
So it's a consistent message.
This consistency validation, profitability, balance sheet strength, and strategic expansion is all designed to signal maturity to the market.
Let's discuss the technical indicators and the liquidity risk. The stock is currently holding above that psychological $1 support level, trading around $1.05.
The technical picture shows classic compression. The stock is trading just below the key 50-day moving average, which is at 109, and the 200-day moving average at 110.
And compression means a big move is coming.
This compression often precedes a volatility expansion. It means a large move is likely coming once a major catalyst or a disappointment hits.
And the liquidity, an average daily volume of 1.65 million shares. What does that mean for you, the individual investor?
This is the double-edged sword of microcaps. The relative illiquidity makes it challenging for major institutional funds to accumulate a large, meaningful stake without driving the price up significantly.
Which is good for current holders.
Right. But for retail investors, it creates slippage. If you try to sell a large block of shares quickly, the order can push the price down significantly, increasing your effective exit cost. Liquidity risk is a critical factor here.
Chapter 5. Ownership structure.
All right, let's examine who owns this company, starting with the insiders. The percentage is very high, which is often a strong signal of alignment.
How high are we talking?
Insider ownership is substantial. It's sitting between 21.8 and 29.8% of the float. This high alignment suggests a powerful owner-operator mentality.
Their money is on the line.
When management owns that much of the company, their personal economic interests are directly tied to long-term share performance, and that mitigates agency risk.
We do have to revisit Mark Fuller's September 2025 share sales again, as this is often a source of nervousness for investors. What does the specific scale of 500,000 shares sold for about $560,000 tell us?
It confirms our previous interpretation. Given his remaining stake of 6.1 million shares, this is clearly diversification. It's not abandonment.
Right.
When a founder successfully hands over the reins and their entire personal net worth is tied up in the company, prudent financial planning dictates diversifying some of that capital. The market should view this as a healthy decoupling from the previous regime.
And the new team is incentivized to stay.
Heavily incentivized. The new management team, led by Ives and Bell, is locked in with those long-term vested stock options. They have to perform to get paid.
Switching to institutional ownership, the low 9% presence confirms that CTM is still largely undiscovered by major Wall Street funds.
That 9% is low, which means the potential for future price appreciation when institutions finally notice the financial turnaround is significant.
Right.
However, the quality of the existing institutional holders provides a baseline of demand. We see index giants like Vanguard Group, who actually increased their stake by 21%, and BlackRock, who buy for indexing purposes.
Are there any active managers?
More importantly, yes. Active fundamental value managers like Essex Investment Management hold the largest active stake at 2.28%. Their presence suggests a belief in the underlying fundamental shift, which helps validate the thesis. Chapter 6. Risk Assessment.
Understanding the specific risks inherent in this turnaround is paramount. We need to run a deep analysis connecting those internal vulnerabilities to the external macro threats.
Absolutely.
So let's synthesize the internal factors first. Strengths are the net cash position and the high switching costs of incumbency, but the weaknesses highlight the primary execution risks.
The primary weakness is the paper-thin operating margins. They're currently hovering around 3 to 4%. That tight margin gives the company zero buffer for execution error.
What could go wrong?
A single lost contract recompete, a delay in staffing for new programs, or a significant overhead surprise could instantly wipe out the quarterly profit and push them right back into operating losses.
And customer concentration.
The second weakness is heavy customer concentration. They rely intensely on the U.S. Navy and NACAD. While that provides that stickiness, it also ties the company's fate to a single procurement entity.
Opportunities include the high margin optionality of Guard Tower AI and the possibility of being an ideally sized acquisition target. What about the threats?
Threats include structural issues like government continuing resolutions or CRs, which delay funding and start dates for contracts, creating cash flow uncertainty.
Okay.
But the most unique, actionable macro threat we identified is tied directly to the 2025 tariff environment.
Let's drill down on that. The 2025 tariff environment is a specific macro risk. The U.S. government imposed new tariffs, a 10% baseline, higher tariffs on specific Chinese goods. How does this affect a defense services company?
The core services business is largely insulated, but the exposure comes entirely through the CATP product subsidiary. CTM is essentially a middleman reselling hardware and software.
Like server.
Things like Dell PowerEdge servers, which contain Chinese-made components subject to the new tariff regime. If a tariff hits a component, the cost of that entire server infrastructure increases instantly.
So if Castellum quoted a fixed price to the government for hardware 6 months ago, they would be forced to eat that increased tariff cost, right?
Precisely. If they fail to manage this, the tariffs could destroy their already thin margins. This is why the crucial mitigation strategy revolves around contract language.
They need specific clauses.
CTM must ensure their government contracts include robust economic price adjustment, or EPA, clauses. These clauses legally mandate that the contractor can pass increased hardware costs, whether due to inflation or tariffs, directly to the government buyer, thus protecting their margin profile. Their success in Phase 2 really hinges on rigorous contract management to include these EPAs.
Finally, CTM is introducing some geopolitical risk through diversification. The TradeWinds partnership involves projects in West Africa, specifically Ghana's Kokoda International Airport.
That expansion, while diversifying revenue away from a single customer, introduces classic emerging market risks. Ghana, while stable, still exposes CTM to political instability, potential currency flux, and a different set of regulatory compliance demands. This requires careful risk management.
But that risk has a strategic counterpoint, doesn't it?
Yes. This West Africa focus aligns directly with U.S. strategic interests in countering regional influence, often referred to as great power competition.
So it could open new doors.
This alignment could open up future funding sources from organizations like the State Department or USA, providing a strategic foothold for non-DoD government contracts. And overall, the continued global conflict ensures high funding priority for CTM specialties, EW and IW, making the long-term defense spending outlook highly favorable.
Chapter 7, Conclusion.
All right, we've covered the business pivot, the discipline management, the robust financial turnaround, and the specific risks. Let's synthesize the bull and bear cases one final time.
What's the bull case in a nutshell?
The bull case is compelling because of the asymmetry. The market is currently valuing CTM based on its past debt-laden structure. The present reality of that $15.4 million net cash safety net provides a massive built-in floor.
And the upside is free.
The high-margin product strategy with Guard Tower AI is essentially free optionality. If execution is flawless and the market simply grants the company a PE re-rating commensurate with sustained profitability, the stock doubles or triples from here.
Conversely, the bear case remains the specter of the value trap.
Exactly. The margins are razor thin at 3 to 4%, leaving no room for error. Their heavy customer concentration means one major contract loss could instantly wipe out their profits.
And the AI product isn't a sure thing.
The AI product is unproven against entrenched incumbents, and the microcap liquidity risk makes it difficult for institutions to buy in and for retail to exit gracefully.
So let's summarize the full valuation spectrum we've mapped out, from the liquidation floor to the most optimistic targets.
We have 4 clear valuation points for you, the listener. First, the net, or liquidation floor, based purely on the liquid assets backing the company, is about 85 cents. This is your downside protection provided by that cash fortress.
Okay.
Second, our DCF base case, assuming stable operations and moderate growth, is $1.07, which is essentially where the stock trades now.
And the potential upside is where the investment proposition becomes truly intriguing.
Yes. The DCF bull case, fueled by product strategy success and margin expansion to 8%, points to $2.45 to $3. That represents over 133% upside potential.
And the high end.
The highest analyst target, based on those aggressive sales multiples, reaches $3.57. which represents the highly optimistic scenario of flawless execution and market exuberance.
So after this exhaustive deep dive into the source material, what is the final recommendation?
Our final rating for Castellum Inc. CTM is long accumulating, and this rating is specifically tailored for value-oriented investors who possess a high risk tolerance and a long time horizon.
And the justification.
The investment thesis is validated by the combination of a strong margin of safety, that 18% net cash floor, and a clear executable catalyst, which is the Phase 2 operational execution and the high-margin product strategy. This confluence creates a genuinely asymmetric risk-reward profile.
That leaves us with one final provocative thought for you, the listener, to mull over.
Okay.
Given the highly efficient operating model demonstrated by that eye-watering 37.5% ROIC once the debt was paid, is the most likely outcome that CTM achieves its full 245 plus potential organically by grinding out contract wins? Or is it more likely that a larger mid-tier defense firm acquires CTM to instantly leverage its top-secret clearances, its SCI infrastructure, and its massive pre-vetted contract vehicles like OASIS plus wraps? That acquisition potential might be the real, most immediate catalyst for the stock.
It's a great question.
That's a wrap on this comprehensive deep dive into Castellum Inc. We hope this has given you the necessary edge to be well-informed. Remember to like and subscribe to Stock Analytics AI.
And a quick and mandatory disclaimer. This analysis is based on AI research source material and is strictly for informational purposes. It does not constitute financial or investment advice. Microcap stocks are inherently high risk, subject to extreme volatility and illiquidity, and investors must conduct their own due diligence before making any investment decisions.
We'll catch you on the next deep dive.